Good afternoon, everybody, or actually good morning, panel. Nice to see you, Vic. I can see you all the way over there. Everybody comfortable? Perfect. So today we're going to talk venture capital, but we're going to talk about more than just venture capital. We're really going to talk biotechnology, pharmaceutical. We're going to talk venture capital, wealth management, and alternatives. And we're going to talk digital health and wellness. So think about those three categories. What I think makes them exciting and why we're here today is we all know that the large biotech conference took place over the last 4 days here in San Diego. There were 18,000 people attending that conference. So this asset space for family offices is so important, and we really want you to think about how this asset space, your portfolio as investors, becomes so important to the family office. Every one of these categories, biotechnology, pharmaceutical, venture capital, wealth management alternatives, digital health and wellness, this gives doctors, this gives entrepreneurs, this gives those that are in the technology better tools. And that's really what it's all about, is making sure that we have better tools for doctors, better tools for those that are in the venture capital area, for the individual companies. So let's just think about those for just a moment. WhatsApp, Facebook, Groupon, Snap, Upwork, Airbnb, Etsy, Alibaba. All of these have attributes that are different on the technology side, and I think Vic will be able to talk to that. When we think about, ideas behind better tools of biotechnology and pharmaceutical, in the middle we have Divya Yerraguntla with us today from Tree Hill Partners. She's going to talk a lot about biotechnology research in the pharmaceutical industry. So at Tree Hill Partners, I think what makes her different is that it's biotech's potential and it's necessary in solving some of the world's most pressing health problems. Vic Sasi, who sits at the end, Chief Strategy Officer at Manhattan West, based in Los Angeles. Some of the firms that he's invested in his firm is M13, Blockhead, TVX, Type 1. And we think about wealth management and alternative investments, and that's really what, the idea of Manhattan West is bringing to the table, is that they're investing in digital and crypto blockchain, co-invest with the best in class assets, access to really good deep stage, so they're investors, and then specialized teams that are really going after good venture capital companies. So think about, this digital assets fund that Vic runs, and we're going to talk a lot about that because I think that brings a lot of technology to bear. And then Cheryl Cheng also was at the tech conference. She's the founder and CEO at Vive Collective. Some of the firms that she's invested in, her firm has brought to market is Hello Heart, Blue Fever, ZME, Kiddo Health, and SEMA Care. So they're active investors, and they invest in early stage digital health and consumer opportunities and wellness. So again, these three areas are all converging to give better tools, better access, not only for doctors, technology, but all of us individually. So Cheryl, I'm going to start out with you today and just sort of ask you a question about some of the companies you've invested in. I looked at Hello Heart, I looked at Blue Fever, I went on your website and looked at ZME. Tell me why those three companies fit into the strategy at your firm.
Sure. So maybe a little bit of history, my background. So I'm originally investment banking, did a stint there, and then moved over into consumer packaged goods. So at Clorox and Procter & Gamble, we got very anthropological in the way that we think about how consumers use products. And so when I started doing investing, no one can deny that healthcare is a giant part of our GDP. Everybody touches it, whether they like it or not. And so we started looking at how we could change consumer behavior. So when we think about companies like Hello Heart, hypertension is probably the #1 killer of chronic disease across all Americans, maybe worldwide, but it's a silent killer. People don't know they have it until they have a heart attack or stroke. So how do you use technology, the smartphone that everyone has in their pocket, to demedicalize this condition that people aren't even tracking? So that's what Hello Heart did. So kind of in the age of Livongo, Hinge Health, Sword, Hello Heart emerged as a employer-facing solution that would allow their consumers and their employees to manage hypertension. And the average Fortune 500 company has about $15 to $20 million of spend every year from a heart-related incident that happens among their employees. So it could be on a shop floor, it could be in an airline, et cetera. So the ability to reduce that cost is important. Blue fever is all around teenagers who are addicted to social media, and it really actually impacts our psyche. So how can we provide solutions to help modulate that mental health? And then Genève is another company that I invested in, which is in the women's health space. So my thesis was 50% of population is women. Every single woman go through menopause, and it is very understudied. There's not a lot of tools. So what can we offer women in the form of telehealth products, services, et cetera? So made an investment in that. And then I also love the pharmaceutical space. So everything across specialty pharma is super interesting to me, and would love to compare notes with you.
We're
sometime
definitely
on
gonna
that.
compare notes.
Yeah.
And would you
By
touch
specialty
on?
pharma, are you talking about pharma that is produced? Like a specialty pharma prescription?
So for me, the definition, so we don't invest in therapeutics. And what I'm more interested in is these high cost medications that are either delivered in the doctor's office, injected, infused, et cetera. So think of oncology drugs, retina drugs, or they could be delivered to your house or through a traditional
So they come
pharmacy.
from a specialty pharmacist.
Yes, they're just very expensive. So all the GLP-1s that everybody is talking about these days, that's a specialty RX. So generally costing $10,000-$20,000 a year to the patient.
Okay.
So Diva, let's talk scalability. Let's talk scalability in the commercialization of healthcare companies, healthcare products. Talk about why you believe in that area to be able to scale up from a $50 million company to a $100 million company to a $500 million company. Talk about how your firm is going to help them do that and why that's so important in commercialization.
So I would actually address the second portion first.
Sure.
Why is it so important? I think as investors, everybody wants to have their returns. So I guess that's the base, right? You want to make sure the company you're investing in is scalable, because whenever you want to exit, you need to have a much higher liquidity and returns for your investment. So I guess looking at a company when you're trying to invest and figure out, is it scalable, is just so important. And I'll give you just one example, right? I've seen this because I come from hardcore pharma background, 23 years in pharmaceutical, then CRO, and now in investing. So it's like been a journey. You see a lot of companies that have done their study. They're like, we are a great product, but the study has been done only in 5 countries. But then in their plans, they have a launch, maybe let's say in Japan, where it's required to have patients from Japan. If you have not thought it through upfront and had patients incorporated in your studies, you're not going to launch in Japan. So that's not scalable, like you're missing out on a whole market. So having that vision on how that company is going to be scalable and how are you going to execute on it is especially important. So I think that's where our company comes in, because we're not just investment bankers. We have operational expertise as well as pharma heads of past merger and acquisitions, chief business officers. We have executives from pharma like myself who have done this. So we kind of go back and see, is this company actually ready for that scalability factor? So from 2 years from now, 5 years from now, when you have a plan to execute, is that an executable plan, right? Or is it just on paper? Will you actually realize those returns as promised? So that's what we help companies do.
And how often are the meetings held throughout the week? Is it all virtual like we are today? Are you boots on the ground in their office 4 times a year? Talk about just sort of how close you really get to that company.
It depends. Some companies, it's more virtual, and then we are across the globe. So not everybody is in the office all the time. Even with the customer, we may have one person and the others joining in, but it's pretty close collaboration, because literally we are becoming an arm of their team to look at what kind of assets they're going after, what kind of returns they're looking for. So we do a lot of due diligence all the way from financials through the scientific data. We go into data rooms to review each and every document they're prepared to see the quality of that document. Is that even, IND ready? Is that even ready for approval? What kind of FDA questions would come back? Are we prepared for that? Do they have a solid strategy in place? And I think Sergey mentioned this, right? And I always believe this, it's like a GPS. If you don't put the coordinates on where you're trying to go, you'll never get there. You know, there are multiple paths to getting there, but you need to know where you're going. So it's so important to understand how you're going to commercialize
Yeah.
whatever asset you have. So you can decide what's the optimal path to get there. And I think that's the key, to understand where you are, where you're going, and then what you need in order to get there. So that's what we help you with.
So hard. You can see why, three experts like we got here today in the different asset classes. It's so important for you as family offices to think about, okay, how do I actually access this? How do I get access to this? And how do I grow my portfolio to make sure that I've got these type of businesses in there? So Vic, let me turn to you. Over at Manhattan West, you launched the Digital Assets Fund. Do you mind telling us a little bit about that? And by the way, I have $100 million burning a hole in my pocket. Would I be a potential investor? Or is it because I don't have a pre-existing relationship with you? Am I shut out?
You're never shut out. No one is shut out.
Okay.
Unless you're on the the OFAC list. But yeah, I guess I'll start. I spent the better part of a decade in early stage venture. I've done about 110 deals across 3 different funds, corporate, institutional, and now Manhattan West. I got seeded to basically solo GP a crypto fund, and at Manhattan West, which is a hybrid asset management, wealth management firm, about 1.3 billion in AUM. But I also oversee a couple different funds. We have a fund of funds, and then a late stage vehicle, and then a more direct early stage fund. So I almost look at myself, I've done this in the very, recent past, almost like going from a GP to an LP. So in that case, yes, you absolutely can invest. And, fundamentally, and I'm, grateful to be here, especially alongside 2 very smart investors. I just look at it as instead of going straight to the source of these companies and doing, and being in the weeds as it were, it's let me just put money behind the Cheryl and Divyas of the world, who are then going to go and, with their army of analysts and diligence and, for 23 years at pharma, et cetera. So yeah, so we're almost abstracting away one more layer and going up to the LP level. And look, fund of funds is a tough business. And it's, at best half of the fees. If they're charging 2 and 20, used to be, 1 and 10, and now that's come down to 75 bips and 5, but at the end of the day, and this is a truism that will, I think, continue, 90% of the returns in venture accrue to the top 10% of the firms. And the dispersion of returns in venture is greater than any other asset class. So if you're a bottom quartile fund in private credit, you're obviously underperforming the benchmark, the public market equivalent, but you're probably eking out 3% or something. And top quartile is 11, 14, high teens. In venture, if you're the bottom quartile, you are losing money for your LPs, over a 10-year time. I mean, it's negative IRRs. It's really, really bad. So that's why it's we have to go source and find the best managers who are then going to go find the best deals. And so, look, no one wants to be intermediating what is already a probably semi-bloated value chain. But at the end of the day, if you're steering capital into the right places that perform, what more can an investor ask for?
Really well said. So Cheryl, let me turn to you and let's stay on that same theme. What are the chances of hitting a home run? Let me pick any company in your portfolio. How do I get a 50x return? How do I find a unicorn? And how do you protect your investors from striking out?
That's a great question. So I tell founders and investors the same thing. So your ability to find a unicorn is this archipelago of probabilities, right? The probability that you found the right founder to do the deal or the company that they've chosen to do. So founder market fit is an important thing. So your chance of that is not great. Then the chance that that founder has been able to recruit the right team, odds are less than 50%. Then the market timing is right, the product is the best product. So when you multiply probabilities, anybody who's taken basic statistics, your chances are actually very small. So the question is, do you need a 50x? Everybody wants that, and that's what we all underwrite against, the fact that you are going at every deal, you have to swing for the fences. Especially if you're an early stage investor. If you get to the late stage, if you're underwriting, so we underwrite across the gamut. So we'll do Series A's all the way through growth. And our underwriting methodology is very, very different when I'm looking at a Series A deal versus if I think I'm gonna be last money in before a company exits or goes IPO. So if you're late stage, you're not underwriting for a 50x. It's not going to happen. If it happens, it's like you're amazing. But at the early stage, we do. And then I think the best way to risk adjust that is to get very involved operationally with your company. So I always say I will let my children run into walls, but not off of cliffs, and because they have to learn, and that's how they learn. And I think that is philosophy for management teams as well, right? They have to build their own culture and DNA to get through the hard times. But as a fiduciary, and we always take a board seat as well, we don't let them run off the cliff. And having that operational domain expertise, I think becomes very important, to your, especially in like biotech. We have to know as an investor where our limits are on domain expertise. And if we don't have it, we have to bring in the right people. So
Great.
that's how we do risk.
Really, really well said. And I'm gonna, Divya, I'm gonna transfer over to you now. Let's talk about regulatory, right? Yesterday, I moderated a panel on real estate and regulatory, which is so thick in everything that we do on the commercial real estate side. But I've been seeing it over the past few years, obviously, on your side of the fence. So talk a little bit about this, regulatory landscape. How do you get through it? How do you keep a company on track? I love the term, versus running into a wall or jumping off a cliff. How do you keep that company going in the right direction? And again, they have to always butt up against these regulatory problems. How do you get them through this?
So regulatory guardrails have been there since a long time, but I guess with more and more technology coming into play and not having too rigid regulations right now where AI is concerned and other aspects, I think it's a little bit more blurry than it was before. I would say regulatory is always a gray area. There's never a black and white. It's always up for interpretation. I worked in multiple companies, right? Novo Nordisk, J&J, Sun. Every regulatory head I have had has their own interpretation of some of the rules that come out. So it's very based on who you're talking to. So understanding what exactly the new regulation is and how do you want to adapt it, and getting multiple point of view, especially for a company that's just starting out. And I see more and more of this because I'm also advising a few stealth mode startups. There are a lot of tech companies that are trying to get into healthcare. So they're great at technology, they have these amazing solutions and an unmet need. But the problem is there are just so many regulations within healthcare that they're not aware of. You don't know what you don't know. So coming in as an advisor, I feel bad telling them you can do that, you can do that. Oh, no. That's an absolute no.
And let me stop you for a second. Those of you in the room that are family offices, and again, you have big portfolios, you're trying to figure out how to do this. Regulatory, working with pros. It is so important to understand these landmines. That's why investing either in a fund or something direct to a founder is so important in getting your job done. So I just really want everybody in the room to think, okay, family offices, how do you do this? Here's just regulatory issues you have to think about. Sorry, I'm interrupting you, but I just want to make sure the family offices realize how difficult this can be.
I guess the theory in tech is break things, but you can't do that in bio and therapeutics.
Exactly.
It's bad to do that.
You just have to be careful. I'm not saying it's bad to do them because I think AI has huge potential that we absolutely need to use because we generate so much data in healthcare. We are one of the biggest data generators, right? If we can't use AI to use our data to our advantage, then who else can? And that's how we will actually really get to the right targets, get to therapies faster. We can identify the right candidates sooner, market dynamics. I think it's a great tool. We just need to understand how to harness that for healthcare. And regulatory is a major area where we need to have experts who can help us guide that whole trajectory of how things need to work. So it's exceptional.
And for the regulatory, how many lawyers do you have on staff? And how many outside third-party law firms are you keeping on staff, right? I mean, there's so many people that are cutting edge, and maybe you have lobbyists in Washington, D.C. trying to direct traffic, right, of certain, healthcare laws. How do you work through that?
So we work with a lot of partners who are specialized in specific therapeutic areas because every therapeutic area is different. So you can actually get to the right partner and talk through this whole strategy to say, okay, this is the kind of therapy, this is the novel product. If there is a, AI component, how is that interacting with the actual, the whole therapeutic cycle of it? So yeah, we do work with partners depending on where we need to go.
You've got to. So Vic, let me sort of backtrack to you for just venture capital. Let's talk about the state of emerging venture capital. So I'm going to ask you to get a little granular here for some of the family offices. Well, let's talk investments, deals, and pipeline trends. So help us a little bit, again, investments, deals, and pipeline trends that you're seeing in this emerging venture tech. I'm sure this landscape that you see on a daily basis is so vast.
Sure. It's I mean, look, there's like this joke that we thought we were done with these 100x multiples, during the height of COVID when everything was up and to the right, but they are back, but only if you're an AI company. And so in the same way how I think it was like Long Island, like blockchain, they like added blockchain to their name in 2020 or something, and then saw their market cap go up or something. Everyone now, no matter what your website was, probably is like .ai 100%. This pivot to AI, and if you're not even mentioning it in your deck somewhere or have some slide, like an investor is certainly going to have their ears up, like, why aren't you? What's your AI strategy? And look, like that conversation is probably happening in a lot of boardrooms at public companies, and I mean just mid cap to large companies, but they tend to be a little more slow rolling. I think, there's something interesting happening. Look, I can, wax poetic for a long time, but no, I want to say I don't want to do that, for one. But I mean, you look at things like, Salesforce had this, I don't know, it was 18%, like 20% drop last week. And there have been, some of these like kind of tremors in the market. And I think part of that is because everyone has just been counting on like, oh, these large companies are going to be able to like monetize their, all this AI business for some of their largest customers. And as it turns out, a lot of these big companies, still haven't exactly figured out what their strategy is going to be, rolling out a lot of these, tools, and like, Salesforce has this Einstein thing, and amongst a host of others, along with plenty of their of these large tech companies. But we have yet to see the results. And so, I mean, I hate to give credit to this like Gartner hype cycle, but like there is almost certainly going to be a trough of disillusionment. I mean, there's 100% going to be a hangover and sobering, with the AI investment. But
I was watching ESPN this morning as I was getting ready, and there was a McDonald's commercial where the girl was with her grandmother at McDonald's, and McDonald's is using AI to translate so they could speak to each other to take orders.
Brilliant.
I think it's jumped the shark. I mean, at that point, McDonald's is advertising AI.
right. Yeah, I mean, I guess I like, to me, and look, like AI has been around for a while. I mean, if you think of it
A long
very
time.
primitively, it's like, look at autopilot on planes. I mean, that has actually been an unbelievable use case of it. And that was, formed in the 70s and 80s, and it's perfected. I mean, they can do auto land. I'm a private pilot, but like you can have zero visibility. I mean, these planes can auto land. I mean, it is stunning. And you'll be terrified if you're in that cockpit, but you can't see anything until you're literally the wheels hit the ground. But also, I kind of always try and keep like frameworks of mental models, and I always come back to this of Amara's law, which is that we tend to overestimate the amount of progress we make in the next 2 to 3 years and underestimate the amount of progress we make in the next 10 years. And that is fundamentally, like, I will stake my life that is going to happen with a lot of what we're seeing now.
So
Good.
my background is math. I actually have a master's degree in artificial intelligence before I got my MBA at Wharton, and I'm a big fan of what I call constraint theory. So you can only grow as big as the market. You can't grow bigger than that. A lot of people get valuations. A great example is that the treadmill machine during COVID.
Oh, Peloton?
Peloton, right. So that was like, great example, right? It grew bigger than the market was. So I think there's a lot of problems with AI. One of them is a lot of the data in healthcare is bad. Like there's this whole lab problem where only 50% of published studies can get replicated, right? So I think the assumption of giving that data to AI doesn't mean you're going to get good data coming out of it. Right. And then the other problem was the data lakes. I mean, how do we know we have sufficient data really to get great answers on things, right?
So I think one of the things, so we spent a lot of time with health systems and insurance companies. And so one of their problems is it's not the mathematical model of the AI. Their problem is that their data is messy, it's not structured properly, it's not cleansed, and it's biased, right? So like they can build models relatively cheaply and quickly, to the point where it actually, for me, makes me nervous as an investor, like, do these startups need to exist if you can hire engineers and pull tools off the shelf to do that? What their problem is that they cannot audit those models correctly because those models start to deviate, they hallucinate, and they don't have the data structure. So like, until we get to that place, which no startup can build for the health system has that information, but it's not in any structure that is possible. So in the AI world, we're not looking at any applications because I think we're gonna go into this trough. I'm actually interested in the infrastructure and the tooling more than I am the algorithm and the application layer. And I think a lot of venture got a little over their skis investing in the application layer before the infrastructure was ready. So it's very similar to like the smartphone apps in like 2007, 2015. Everybody needed one, but they weren't sure why. And then they realized it was actually very expensive to maintain and they couldn't do a lot of things they wanted, like payment rails and like security and like single sign-on and stuff like that. So then those companies got built. And I think we're gonna, as an industry, have to take a step back to build those things for AI before we can move forward.
I completely agree. In my past life, for the last 2 years now, we've been struggling to get that data in a shape that is usable.
Yes.
There's tons of data. And to your point, like we have multiple 49 data sources coming into the data lake, but they're all in different formats. Even to normalize the data is just so expensive. So it's not the lack of data.
It's like an old story on Wall Street because
Yeah.
all these financial firms have been acquired and merged, but they all use the original databases and systems that they bought that were built in COBOL, you know, in the
Yeah.
1960s, right?
So just normalizing that data, making it usable, especially in healthcare, you have the privacy issues as well.
Yeah.
A lot of it is de-identified. So you can only do so much with that kind of data.
Vic, thoughts about this conversation?
Yeah, I mean, look, I'll leave it to the experts. I mean, I totally hear everything you're saying. I mean, speaking of what Cheryl was saying, the last deal that we did, we lifted $30 million of Anthropic. This was a month ago, out of the FTX estate. You know, Anthropic being one of the, you know, I don't know, one of the second most prominent, you know, competitors to OpenAI, or the most prominent competitor to OpenAI. And now we're looking at Grok, this, you know, kind of like chip/inference, you know, company that was incubated by Chamath at Social Capital. It is still wildly, I'm wildly uncomfortable. Despite, you know, despite the fact that Anthropic was at like a.
Yeah.
But why are you
$70 billion
uncomfortable? Explain to people why you're uncomfortable.
Because, you know, every single time, you know, OpenAI or, you know, whomever, Anthropic, Mistral, you know, even just Meta with, you know, with Llama, you know, every time they ship a new product, it's like they race ahead of each other in these rankings. And, you know, in terms like which LLM is better. And, you know, I don't know if we're going to win that. I mean, there are so many different avenues that this whole world can go as to like, is it kind of like Sauron all, you know, it only needs to one, you know, it's only one model to rule them all, kind of, or is it going to be really fragmented and maybe like sector specific? You know, Anthropic is going after the enterprise business. OpenAI is, you know, clearly very consumer focused, so they're obviously going after a whole bunch of things. Yeah, I just have no idea. And look, like some of the smartest funds are sitting out, you know, this quarter, and they're just saying like, we have to wait until things shake out. You know, Cheryl was saying with the applications, like certainly, I think it was like, I don't know, like 50 or like, no, not 50%. It's probably like 20% of, you know, startups in the Y Combinator batch from like last year basically realized that OpenAI was their direct competitor when they launched that, you know, assistance API in like their app store. And so it was just like, oh, geez. Now there are some benefits in that these, you know, even just ChatGPT wrappers have basically no cost. And so if you can figure, I mean, obviously there's very little defensibility and, you know, supplier power, but that's the thing. It's like, you know, this heralds this whole new, you know, paradigm shift and all this stuff, but getting there is just really messy. And again, when you're investing with like insane multiples, it's like we've generally seen how that movie ends.
Right.
And yet I can't help but watch it and like occasionally.
Well, I mean, it's almost like Elon Musk spaceship launches. There's always a FOMO launch out there, like it's in alignment. It's one after another.
Of course. But the other thing that I think financially that, I don't know if you're doing this yet, but like people fell in love with enterprise software, right? Because they were like, oh my God, look at these 85% gross margins and like blah, 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 right? But in healthcare, everything at the end of the day is delivered by human, services. And so people don't like that, right? Because they're like, oh, services are going to have like terrible margins. But one of my questions is, when you go into AI, the expensiveness of compute, should that be put into COGS? Because or is it really kind of sitting down here in R&D, which is like below the gross margin line, and like it's sort of like hidden? Because when I look at like enterprise software companies, there's actually a lot of costs that goes into powering and growing enterprise software companies. If you only look at gross margin, you're missing a lot of the picture, right? Like you have to look at like the number of companies that are actually throwing off EBITDA. And in the AI companies, like I have this question as well. Like, I don't know if we know how to treat that yet, but the compute is really expensive at scale. And so I don't see people putting that in cost of goods yet. But I am actually encouraging companies that we talk to look at it both ways. Like, I'm not saying have like two sets of books, that's not the point, but like you need to look at your business from multiple angles to really understand the unit economics of how healthy it is. And then I think my fear is like that adoption is going to be a little bit slower than we think.
Right.
So it's going to need more venture money.
Yeah, and
More
no
money.
one's, and to your point, I mean, no one's looking at unit economics of these companies. I mean, they're looking at them, but it's just like, well, if your TAM is infinite, or like, gross GDP of the world, then like,
Why are we
don't
thinking
worry about
about
gross margins. This is just, it's like you're overthinking this. It's like, am I?
Yeah.
So Cheryl, let me come back to you. When we spoke earlier, you spoke a lot about, the whole child, improving their healthcare. Talk to the family offices and, what Vive Collective is doing to really help the whole child. Talk about that, because I think there's so many applications that your firm is working on, but I think a lot of the family offices really haven't picked up on that yet.
So I think there's multiple aspects when you think of healthcare, right? And like, you can't throw a rock without hitting some healthcare problem. But I think you have to really stratify that, because populations are different. So some people have more access problems. So if you live in a rural area today in the US, there's probably no specialist that is within 30 miles of where you live. Behavioral health, GI, cardiac, whatever. So solutions need to go in and solve an access problem. But for other populations, it's a clinical outcome problem. Like, you're not actually helping me move the needle on my diabetes, right? And so when I think about it, and when we look at companies and founders, we think about all of these different aspects. And we actually don't like companies that are trying to solve everything for everybody at once, because then I think you're just going to do a bad job for everyone. Instead, it's like, all right, if you're a rural health company, really explain to me, like, what is your wedge and like, what are you offering for that population? And then eventually you can go into other populations. So when we think about whole child in the whole healthcare system, we really think it's multiple solutions, and the space is so big that I rarely think of it as, oh, you have 10 competitors, so therefore, the market's super fragmented, you won't win. There are more than 10 large health systems in the US, and they're all doing just fine. So I think about that for tech companies. I actually would rather see them, crawl, walk, run, as opposed to raise tons of money from day one and say, we are going to build this super shiny product and then go look for the patient. I would rather have them find their patient cohort and build for that, and then go from there.
Great point. And let me come back to you, Divya, on the idea of intellectual property. So I think a lot of family offices realize that intellectual property is out there. They want to be involved. They want to try and invest in it. Talk about what's going on in your world in intellectual property, the strategy, marketing, coming to market. How is that so important to your portfolio?
I think it's important in any industry, but in healthcare, it's absolutely important, because if you don't have a solid IP, you don't have a product, you don't have a runway for your product and for your company sometimes. And we see more and more biotech companies which are like one asset companies. So that one asset is their entire company. If that fails for whatever reason, you don't have a strong IP, you don't have a company, and which means it leaves all the investors stranded. So I think as an investor, I would really encourage to make sure whichever company you're looking to invest in has a solid IP. And it has a roadmap on how that's going to evolve as well, right? As you get close to exclusivity loss, how are you going to ramp up as it comes to the peak sales? Like, how is that IP going to sustain itself and also kind of take you into other indications? Because a lot of times you have a great platform or a great molecule that may, and we do this all the time, right? We would take one product and look at it and say, okay, there are 10 indications you can go after. And there is a strategy behind it as well to say, is this the indication because that's the biggest market versus is this the indication you want to go in first because that's the easiest approval route? Because you want to be in the market first, so your investors start seeing some returns. So you want to go with that indication that's the easiest to get approval on, and then kind of get to the next indication through the same molecule, because now it's approved, it's in the market, in patient population, then it's easier to justify some of the other indications on it. So
And what are the costs to these companies to protect, start, making sure that their intellectual property is not going to be taken, their intellectual property is not going to be leaned into and somebody else, garnish some of that information? How does a smaller company protect their intellectual property?
you can come to a firm like ours, so we
Okay.
can help you. Of course. We can look at it and then make sure we're getting the right legal advice and making sure IP is as strong as it can be. Not just for what you're looking at today, but the whole growth trajectory, where you want to be for your investors. Like we were talking about the scalability factor,
Yeah.
right? If you want to be scalable, how is this IP going to help you get to that scalability? We can do that, or you can always work with some of these IP firms that specifically look for biotech IP.
So Tree Hill, if you're thinking
Yeah.
intellectual property. So then let's talk the market, right?
About 10 minutes.
Okay, 10 minutes, perfect. So, all right, so we're halfway through the year, right? We're in June already. Talk to me a little bit about, and again, the family offices, if they've missed the curve, that's okay. How did VC new opportunities for family offices, firms like yourself, shake out in the first 6 months? Was it slow? Was it fast? Was it better than last year? And what do you see going forward? What's sort of on the horizon? And more importantly, for a firm like yours, what's on the bench? What are you looking at that's on your bench that you're just ready to sort of take a dip into and maybe put some money out with?
Sure. So I'll start, or I'll actually maybe only speak about like sort of like the fundraising
Sure.
piece. So it feels like already halfway through the year, most of the institutions, pension funds, endowments, foundations, et cetera, have likely already made their allocations for venture for calendar year 2024 by the halfway mark. And a lot of that, like normal, has gone to the mega funds. I mean, there's a reason that Andreessen has $50 billion of AUM in a matter of 15 years. And it's like this, Ben Thompson from Stratechery has this term called like an agglomerator. And that's basically what they are of capital. So, those funds that have been around a while, it's like this, kind of like the Lindy effect, but like they will just continue to stick around and likely get, get more and more capital. That does present an opportunity for family offices and fund of funds, et cetera, to invest in these emerging managers who, one, are very much overlooked, are having an incredibly challenging time per usual, but especially in this environment, in this macro environment, for them be able to get checks from folks where they wouldn't even be able to get in front of. And so that's where we're taking a look at. Now, look, it's emerging managers are can and if you find really good ones, can and generally do outperform. And look, a lot of these are trying to build the next generation of firms, and that's exactly what you want to be. You want to have that courtside seat from when they're still growing and even their fund ones or fund twos. But it's high risk. Obviously not all of them will make it, and there were a ton of folks that left your tier one fund in 2020 or 2021 thinking like, oh great, like everyone's getting exits, this is like amazing, I'm gonna strike out on my own, I've got a good relationship with the handful of LPs and I'll raise 10, 15, 20 million bucks on my own, or maybe partner with someone else and go raise 30 or 40. And those chickens are coming home to roost because they may have over deployed during what is likely going to be a bad vintage in 20, maybe 22. And now it's like, they don't even have like decent markups or anything to show. And it's kind of like, shit, why did I leave my like 7-figure cushy gig at AA? Like, what was I thinking? But yeah.
So what percent of the successful startup managers, VCs, are lift outs versus coming out of another tech venture or something like that. So they're either lift outs of Andreessen Horowitz or, you name it, or, somebody who's an alumni of that group, or they're coming from a venture, from a firm that was funded and did well.
I definitely don't have a percentage, but were you about to say something?
This is only anecdotally, and maybe I'm biased because where I spend the most time, and Vic, probably you too, is like Silicon Valley in New York. I think more are spin outs of larger firms.
Lift outs, yeah.
Lift outs than they are former operators who have then gone to start firms. Because there's actually there's a whole business of venture that operators don't always understand. And so if they do it, if they made money as an operator, they're probably just gonna be an angel investor first and do that for a number of years and maybe do an angel syndicate with a group of friends and, VC friends. They're not gonna institutionalize their fund just yet. That's what I see in Silicon Valley. I don't know if that's.
I mean, I think in the hedge fund world, it's about 95% are lift outs versus some guy just wandered in and said, I'm gonna start.
Absolutely, right.
Hedge fund
They're
and
leaving all the
private
good
equity
jobs.
is probably 80 to 90%.
Right.
Well, those for sure, because
Right.
the capital base you need to get started is sometimes so much more. In venture, you could start with $5
$5
million,
million, yeah.
right? I mean, there's no,
Sure, you can
there's
start.
not a lot
but-
of, well, it depends on whether you need the fee. If you don't need the fee to keep the lights on for your day job, then you could start with $5 million. You can make some great investments, small checks, but you could do really well. I don't know how you could do that in private equity.
Yeah, I couldn't agree more. I think traditionally lift outs have been, from Sand Hill Road, was basically the only way that you could, sort of spin out, you had to start off. But now there are a bunch of different ways to, prove your value. I mean, even if it's marketing, I'm forgetting the name of, these folks, but even strategic communications and PR.
Yeah, there's
in and of
a
itself.
few out there that are brand VCs, right?
Exactly. I mean, there are a bunch of different ways. I mean, look, at the end of the day, if you can be actually helpful to founders, that is all that matters. And most venture capitalists say they are, but they generally aren't. They get on their board, they get their allocation, and then it's okay, whatever.
Name
Maybe
three.
they were calling it consultative venture. which,
Yes.
Consultative venture. I mean, I'll say this for it doesn't even matter if you're a tier 1 fund or a no-name fund. Generally, look, we all operate on power law. And so every quarter or every, period, whatever period of time, you should be ranking of my portfolio companies, which ones are likely going to be our potential fund returners or are going to drive returns. And I should just be focusing all my time on those. And while, yes, I love all my children equally, there's one that's has a full ride to Harvard, that's struggling with algebra 2, and they're a junior in high school, and it's I think I should probably keep funding this one,
Oh,
and
that's
so
not wise at all.
yeah, they're not gonna get dinner, they're gonna get more of an investment. And so at the end of the day, that's basically what you have to do. And look, as you grow in your career, you have way more boards to sit on. You're just so time constrained that you're and to do right by your LPs, by your family offices, by your investors.
Right.
Your fiduciary duty is to focus on the ones that are winning, and a lot are going to be left by the wayside.
And as a
Glad I'm not
founder in a
retired.
portfolio, you're competing two fronts, right? You're competing against your competitors in the market, and you're competing against the founders that are in the portfolio of your investors, because they have to operate, as Vic said, loving all children equally, but not always giving them equal attention.
Sure.
So we have a little less than 5 minutes to go. So let me just sort of go right down the road and Cheryl, let me start with you. Family offices, right? We've got so many here in the room, so many that'll be, watching live. Ideas, thoughts, ways for family offices to access your world. How do they do this? And how do they do this without having, anybody, in the biotechnology, technology, VC space on, their board? How do they start to make these, opportunities to invest? Or some advice for them?
So I have never fundraised from family offices. I actually don't even know how to do that. So, I would say leverage friends like Marty, right? Who can help, match relationships and interests, I think is the most important thing to the right managers. And then I actually think and I'm gonna be a little more contrarian, because I know this runs against the face of like the mega funds. Like, I think managers need to work with family offices in particular. I wish we could work with institutional investors as well to build the relationship through a series of deals that you do together. And that might take a year, 2 years to do that, and like leverage SPVs, leverage series
That's a
LLCs,
standard approach.
like, like do that. Because to be honest, like for me as a manager, like I'm worried too, right? Like if you're my LP, like I feel a tremendous amount of stress
Yeah.
to like
Yeah.
deliver returns for you. And I want to make sure that like you're also wanting to help me build my track record, my like
Yeah.
strategic thinking. And so I think it's like a two-way thing. I think it'd be very difficult to just go in and be like, here's my deck, and like this is what I'd like you to, I'd like you to write a $5 to $10 million check. So I think it's starting those relationships and conversations, and then looking at a few deals together, and then voicing like, this is what I like, or what I don't like. Convince me why I'm wrong or right. So having that dialogue.
And look at 18,000 people down the street and still there today. I wonder how many are actually investors, how many, are family offices versus individuals like yourself that really understand the science of the VC of building a fund.
Yeah, and everybody brings different strengths. So
Exactly.
figuring out how to match that up.
What do you think? Ideas for family offices to access your world? Come direct to Tree Hill? Do they bring somebody on board? How do they just begin that process? Because that's really what family offices are thinking. How do I enter this space?
So we are essentially transaction advisors. So we do a lot of work with big pharma companies, hunting for products for them, for companies. We do that with biotech companies. So I would say you can come directly to us, or again, I would say Marty. Sorry, we're all directing them to you. But go to Marty and he can engage us as you need. So when you're looking to invest in a company, we can always come in and do a due diligence, not just from the financial aspect of it, but also from the science aspect of it and the operational capability of it. Like, what would it take for them to get operationalized? And I think that assessment really helps, not only even if you have an exit before you commercialize, because you just want to have exit before that, having a plan increases the value of the company multiple fold. Because Pfizer is not going to buy you because you have great phase 1 data, right? Or phase 2 data, and you have done absolutely nothing to bring it to market. You have to have thought things through from the beginning. So having incorporated all of the elements to get to a point makes your company more attractive and viable for an exit. So having that thought process put in is important. So you can come to us and we can help you see whether the company you want to invest in has done that, or we can help them do it, so that the exit is more profitable for the investors.
And Vic, same question, but just something for you to think about if you want to help the group a little bit. I was thinking this morning about some of the venture arms that are out there, right? So there's a lot of these big companies that have their own venture arms and are competing directly with you, the family offices. Think CAA, the entertainment company, they have their own venture arm. Think about Apple and Google and Alibaba. All of them have venture arms.
Hospital systems.
Every hospital system, everybody that's over at the conference, they all have venture arms. So how does a family office, even with a $500 million portfolio, compete, and how do they get access?
Yeah, so one is, and I started my career in venture at a corporate venture fund. As family offices, you have nothing to worry about going up against corporate venture funds. And I'd say one is because, look, the incentives, as Charlie Munger once said, show me the incentive and I'll show you the outcome. For a lot of corporate funds, the incentive isn't purely financial, it's very strategic. So that muddles, how you invest, the deal process, everything. Secondly, and this is something that even if you run a really great fund and it 3X's, you're a top quartile at 5X's, whatever, that is likely going to be a drop in the bucket compared to that whole enterprise balance sheet. It's like, so the CEO isn't going to all of a sudden like elevate the board or something just because you're a great investor. It's like, okay, well, I just hope that investor got carry, which normally doesn't, it isn't even possible at corporate funds. So yeah, one, don't worry about corporate funds. I would say, just going back to what Cheryl was saying about crawl, walk, run. If you're going to do directs, do it in your sphere of expertise, and whether it's textiles, healthcare, whatever it may be, because that's where you truly do have an edge over lots of other investors, if not all of them. So that's one, and then two is investing in the funds. So you can sort of like learn, where you'd like to play. All of this, to underline all this is a commitment to the asset class because you're not going to get returns for 5-7 years. You might get markups, but markups are not money. So just keep that in mind. And then eventually you can always hire, someone to sort of like oversee a lot of venture efforts because at the end of the day, fundraising, sourcing, it tends to be pretty opaque, and every emerging manager and every fund wants to be in front of a bunch of family offices. They can't get, and those family offices don't want to, get inundated by carnival barking clowns, about all these managers. So I think that's why you do need trusted channels of distribution and expertise like Marty, like IvyFON. And yeah.
So family offices, please take those phone calls, please take those meetings, listen, read the pitch books, get on some of those Zoom calls that you're all invited to. You might find that little nugget in the rough that, could double, triple your investment. So Marty, thank you very much for the time today.
Absolutely,
Good to see you
yeah.
again.
Great job, guys. Thanks.
Thank you.